unit. Like I promise you, that 10 unit is not going to cause you any more pain or suffering or stress or time than that duplex would. And you're going to make way more money.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have another great guest. We got Vince Gethings. Vince, how are you doing today?
Great. How are you doing, Todd?
I am fantastic. So a little bit about Vince. He has over 7 years of multifamily investing experience. He currently owns and operates 20 units in his personal portfolio, an additional 52 units in his JV, 48 units as a GP, and still kicking butt. So you'll have to correct me if I'm wrong, because you're probably just buying stuff all the time here. So he specializes in market research, due diligence, strategic planning, project oversight, and execution. Recently held the position of resource advisor for the U.S. Air Force, where he drafted and managed the operational funds and projects for a $1.4 billion enterprise. So with that said, Vince, why don't you give our listeners a little bit more about your background and what you're doing today?
Yeah. Thanks for that background. So I'm active duty Air Force, just about 14 and a half years. I'll be transitioning out of the military right at my 15-year mark, which is kind of contrarian to anybody in the military. They tell me to stick out to 20, but I'm very passionate about real estate and ready to make that jump and, cut the ties with the W-2, even if it is the guaranteed pension that I'm giving up, and I do real estate full time. For the bio, I got to update that. So right now, we're March 2021, we're at 290 units.
Nice.
With another 200 under contract right now. That'll be closing here over the next, 60 days or so. So we definitely have that traction, that momentum that people talk about. We're in it, and it's pretty exciting to be along for that ride of watching this growth that people talk about, this exponential growth. Once you hit that hockey stick kind of curve, we're living it. So it's pretty awesome.
Well, let's talk about that, because a lot of people want to know what that's like. We hear from all kinds of people that already have 2,000 units or whatever, and it's like, oh, that was ancient history. So it's fun to talk to somebody who's right in that growth curve as we speak. So let's talk a little bit about the growth curve. Maybe just give me a little overview of where we already talked a little bit about where you're at, but like what have you been doing to get that growth curve going, and we'll go from there.
Absolutely. And that's a really good question, because I remember, like, even just like 3 years ago, talking to people like, I talked to like Kenny Wolf or something like that. I'm like, this guy has 4,000 units. Like, that's crazy. I can't, and then like, it's almost not relatable. Like, you can't picture yourself at that level. So when you're seeing like somebody that's like 300 units or something like that, then it's a lot more relatable to be able to kind of understand where they're coming from. So good question. So I can give you kind of a timeline and then kind of answer that. So I started real estate, like investing in 2016. From 2016 to 2018, I bought about 20 units, but they're all duplex and fourplex, because all I knew at that time was like bigger pockets. So all like Brandon Turner's books and everything like that, great for buying, the smaller property. Then I hit a wall because I ran out of capital. And with residential, it's not as easy to do like refi and rolls and things like that. Just because it just takes longer to capture that equity. So had about 20 units, realized that multifamily is the way to go. So we switched over our education to get more multifamily experience, get some coaches, some mentors there. Then 2019, we bought a 52 unit, and that's that JV you said about in the intro. And then 2020, we did our first syndication, which was a 48 unit. During the beginning of 2020, right when almost a year, we're on our 11th month right now of that acquisition. And then at the end of 2020, we closed 3 more deals by the end of 2020. And that is, so between really when it took off is, we closed the first syndication. That was like the most stressful thing anyway. Like, why does anybody want to do this? It's so much extra work. JVs are so much easier, and they are. but syndication is a tool, and and it has its benefits. And once we figured that out, we kept really good documentation of it. So everything we did right, everything we did wrong, lessons learned, documented our systems, our processes. And that was like March, April last year. And when you do that, it's very tedious, very time consuming, but it's like solving the Rubik's Cube. And if you ever solve the Rubik's Cube once, how fast can you do it? It might take 10 years to solve it the first time, but once you solve it, you figure out the algorithm, then it's just like, I can do this in 2 minutes now, right? And that's kind of what it was like, because that was April of 2020. We closed that first 48 unit. We got under contract on a 57 unit in September, like a 22 unit in August, and then we came on as a co-sponsor on a 72 unit in like October. We closed all of them in the last 2 weeks of December. So we essentially doubled our portfolio in 1 month, within 2 weeks period. And it was all just like, again, solving that Rubik's Cube. And it was a lot, the stress was a little high just because you have 3 deals going parallel, approaching the end of the year. So people are, a little bit antsy, but solving the Rubik's Cube, stick to systems of process, good documentation. And we did it. We closed all 3 of them by the end of the year. We closed, the last one was like 2:30 p.m. on the 31st of December. I was signing the documents, the last one. And I was like, wow, this is what it's like that people talk about, that exponential growth, that like hitting that hockey stick curve. Because 9 months earlier, I was like stressing out because I did my first 48 unit. And then it's, again, you develop systems and processes, those team relationships and everything like that. And then it's just off to the races from there, and just rinse and repeat. And then now, again, 3 months later, we have another 3 deals under contract for 160 units. So
that's great. What was that? What was that mindset? Like, what made you go, I'm buying these duplexes, fourplexes, I'm going to buy a 52 unit building. I think or 58 unit, whatever it was. You're like, that's a big jump, right? It's not like you went and bought a duplex and then went and bought a 10 unit building. So what was that mindset shift? Like, what got you to say, okay, I can do this?
Yeah, there was a couple aha moments, as they like to say. The first one came when, so I had the 20 units, right? So I had the 20 units. At the time, I thought I was doing pretty good. So the first aha moment came when I was like, I have 20 units. I have decent systems for my level of education and experience, but I was still spending a lot of time to manage these 20 units. And I wasn't even managing. I had third-party management. I was still like, because that's 20 units, about 6 or 7 properties, I think, addresses. So that's, 7 insurance bills, 7 tax bills, seven of everything, right? For just 20 units. So I was like, man, this is kind of turning into a part-time job, not really that passive. And then, so that was one of the other things, like I realized I was building another job. One of the other aha moments was I went to go refi. So when you're doing the small properties, they're a lot easier to get because they're a lot more plentiful. You can go get conventional loans, 30-year AMs, 20% down financing. They're really, if your credit's good, you're probably going to get the loan, right? So that works for a few when you're trying to scale and grow a portfolio, but then you're going to run some issues like your debt to income ratio that most people often don't think about that. So when you're trying to scale and you're like, okay, I want to get 50 units in 3 years, that's a lot harder to do when you're doing duplexes than when you're doing multifamily. Aside from just capital alone, even if the capital injection is the same amount, just because you're going to be doing, conventional loans, when you're going to get cut off from the conventional loans somewhere around like 7 or 10, they're just going to cut you off saying you can't get anymore. And then 2, every single one of those is on your personal credit. So I had 20 cash flowing units, portfolio was very healthy, and like, your debt to income ratio was like 80%. Get out of here. like we're not giving you another cent. And I was like, wow, I didn't think of that. Yeah. So then I was like, okay, that's a problem. Aha moment. My personal credit is trash now. So I was like, well, I'll wrap them up in a portfolio loan, refinance them into the LLC, refinance the debt into the LLC, and get them off my personal name. So that's what I was going to do. It was a great plan. I went to do that, and residential properties, the other aha moment is they are comp value approach versus income value approach. So I got all my appraisals back and I got slaughtered. And I was like, this is crazy. I bought this 4-unit for 170,000, increased rents, $200 a door, put like 50 grand into it, making it all nice. It's the best property on the block. And the appraiser's like, yeah, but it's also the only property on the block. Like the next one's like 3 miles away. So it's worth $170,000. I have nothing to comp it against.
Yep. Doesn't matter how much money it brings in.
Exactly. Or how nice it is. It's going to be, it's worth the same one across the street. And that one sold 6 months ago for 180, yours worth 180.
Yeah.
So that I just had like, a bunch of money just vaporized, essentially on paper. Like the only way to capture that would be to sell it. Yep. So I ended up losing a bunch of equity there. And that was like kind of the last straw of that, of just having all my equity illiquid. Couldn't capture it. I had good cash flow, but you can't scale with just cash flow. So I was like, okay, that this small properties is not the way to grow. If you want to get to 100 units and you're trying to get there with duplexes, you're in for decades. It's going to take decades to do that. So, or I don't know, decades, but a very, very long time, a lot longer than my timeline. And so that was another aha moment. And then that was solidified. I was at a meetup and I had, again, 20 units. I was at one of the local RIAs and I was talking with an older gentleman, somewhere around maybe like 55. And he's like, wow, you got 20. He's like, in another, if you keep up, by the time you're at me, you'd be at like 60. And I was like, what? Like, what'd you say? Like, that's like 30 years from now. And I'm only going to be at 60 units. And that was the other thing, was just like, my goal was like 200. Like, I'll never reach my goal if I just keep buying duplexes. So I was like, I got to figure something out.
Hey, real quick, I just want to let you know about the multifamily challenge that we got going on. It's a 5-day multifamily challenge on how to get an offer in quickly, right? So we're going to teach you in 5 days, 5 1-hour sessions. We're going to go through the steps and the process to get there. So go to mfichallenge.com, mfichallenge.com. You can sign up. It's free. If you want the VIP, there's a bunch of things that we'll give away too. You do have to pay for that, but hey, it's going to be well worth it. Again, you can get in for free. We're going to teach you how to get that offer across the table, get the LOI in, all the steps. So Ellis Hammond and Ellis was episode 316. Check out his episode. And we're going to be doing this next week. So sign up now at mfichallenge.com, mfichallenge.com, and get in there. We're doing it next week and it's going to be awesome. So hope to see you there.
And I'm seeing guys like, David Tupin and stuff like that. We're starting to, spin up. I'm like, this guy's younger than me and he's crushing it. What's he know? It was multifamily. So went out, found some good coaching. And that was, for context of how much the actual start of that curve was, fall 2018 was when I was like, I'm never going to buy another duplex again. I'm only going commercial. I went in, joined one of those coaching groups, got all the education I need, fall of 2018. And by March 2019, I was under contract on that 52 unit. So, and then from there, again, off to the races. Like that was like the start of the curve, or start of a curve, because I was kind of on this linear path of, a couple duplexes a year. Then it's like, okay, now we started curving once I went to commercial, and then, learn all the best things about, scaling and economies of scale and efficiencies, all the tax benefits that's just blow residential out of the water. And it's like, income value approach of, increase the NOI, you get wealthy, right? It's like, it's a very much better equation. So I was like, I'm never going back.
So when you talk off to the races, like what type of things were you seeing? You bought that first property, you got the second property. What types of things are you seeing that helps you with your successes? Was it just a mindset thing, or is there, are people respecting you more? What were you seeing? How are you able to continue to grow?
Got it. So I think the first one's definitely mindset, because a lot of people are like, that's not achievable. It's really not that hard. It's not like rocket science what we do. A lot of it's just people have these internal limiting beliefs, and we talk about that a lot. A lot of the coaches and guru type people talk about limiting beliefs like it's some kind of buzzword and kind of gets old, but it's absolutely true. When I try to tell people of even like my coworkers and stuff, I'm like, hey, you can go buy, like you're talking about buying a duplex. I'm like, you can go buy a 10 unit. Like I promise you that 10 unit is not going to cause you any more pain or suffering or stress or time than that duplex would. And you're going to make way more money, and it's a commercial property, and you can grow and scale your wealth. So a lot of it's mindset. People think it's like, oh, multifamily is scary, but it's easier. These properties get easier the bigger they are.
Yep.
The other side of it is control. A lot of people, they feel like they need to control every aspect. Either it's from a scarcity mindset or from I just need to I need to be able to control everything because that's how my brain works. I need to control every aspect. I don't trust people, things like that. Like I need to make sure it's done right. So I need to do everything. That is probably one of the biggest limiting behaviors of people like actually hitting that growth. Because if they have to do everything, they're their own bottleneck to their own growth. Mm-hmm. So as soon as you get over that, like, okay, I'm going to find some really good teammates that have the same ethics, values, principles, goals, timelines that I do, and that I like the, they're fun to be around, and we have good working relationship. Team up with them, and then now you get like the kind of those synergistic effects where you can do two or three, 4 people where each of you may have only been able to take down a 10 unit, right? So individually, you might have 40 units that you may have to take down. You get 4 people together. I'm at 290 units in a year and a half since joining my team, and there's only 4 of us. Where each of us on our own, where we before we joined, had a little bit of a real estate experience. Like, I had 20 units. My partner Duke had a few units. Steve had a couple units and a couple Airbnbs, but we weren't like scaling because we were on bottlenecks. See, there's no delegation. There's no dividing up responsibility. There's no focusing on things you're good at and passing off things that you're not good at to somebody that can complement that. It's just you have to do everything. Yeah. So that was probably one of the biggest ones, is teaming up with other like-minded people and hitting that synergy and scaling really fast because of that.
Yeah, that makes a lot of sense. I mean, I tried to go at it alone for a long time in the multifamily world. And once you start teaming up with people, it just, are you giving up a little bit of control? Absolutely. Are you giving up some equity? Absolutely. But what you're gaining is just far greater than what you're giving up. There's no question about it. So what's a mistake that you've made along the way, and how have you learned from it?
Great question. So some of the mistakes we made. So one of the best practices for the mistakes is keep really detailed notes, especially if it's the first time of doing anything, is just keep a running log of everything you guys do, the first deal you do, and then do like an after action kind of debrief of like when the deal closes or if the deal falls through, just like, okay, let's go back, look and see where we screwed this thing up, to develop a system process and learn from it. So having the documentation of the deal as it's progressing, almost like a daily journal. That's what I did on our first syndication meeting. I did a daily or weekly journal of this is what I did right this week, this is what I did wrong this week. So one of the first things is having ambiguity in roles is very detrimental to team growth. So if you're like, okay, let's all join the team and we're all gonna go tackle this deal together. Mm-hmm. And then you get a deal under contract and it's like weeks go by and like, I thought you were doing this. Well, I thought you were doing this, right? That adds a lot of friction, a lot of delays and things like that. Like, who called the insurance company? We're closing in 2 weeks. Like, well, no, you're not. Like, not if nobody's even called the insurance company. Do you even have loss run? Like things like that. So having that ambiguity of roles, it'll just delay everything and it causes a lot of friction, because roles often the next conversation is going to be like, okay, what's the compensation for the role that you get that you're signing up to do? So you have to be very clear on your roles of each team member, so they have the accountability of it, have some kind of team accountability mechanism, like a tracker, Trello or Asana or Monday or something like that. And then make sure the compensation matches. So if you have 90% one person's doing 90% of the work, they should be compensated more than the other people. And that was one of the biggest mistakes we did, is I went from a JV, which was everybody put in 25%, equity was split 25%, couldn't be easier. Then going to a syndication. We're like, oh, we'll just copy that over to syndication. We'll all be sponsors. It'll be great. Then quickly realizing that the roles people were doing were not 25%. It was like 80-20. Why the 80-20 principle is so prevalent in everything is it was like, 80% of the results were coming from 20% of the people on the team. So that, led to a lot of resentment. It was like, hey, we're all 25% here, but I'm doing like 20-hour shifts to close this deal, and you're hanging out at the beach. So we need to talk about this. So we got through it, and it was a lesson learned of figure out the compensation structure, the roles, get very clear on that, get those accountability measures in place before going into the deal. Because even if it's a little bit uncomfortable at first, especially if you have pre-existing, it's like your brother-in-law or something, it's kind of weird to talk about stuff like that, but do it now because it's going to get a lot worse. Like, the 11th hour on a deal, and you got earnest money hard and all this stuff, and then now you bring it up, or even 6 months later, when you're in the deal, or even worse, when you sell the deal, and it's like, how'd this clown just get a check for $2 million and he hasn't made one meeting in the last 5 years, right? Things like that. And then it's a lot of resentment. So that was one of the big things we messed up on the first one, is not getting very clear on roles, responsibilities, and compensation structures for the teammates.
Yeah, when emotions are running high, that's not when you want to be making decisions or saying this is what we deserve and don't deserve and so on. Yep. That's when people's feelings get hurt. Nobody's happy in the end, for sure. So, yep. What somebody kind of going, hey, I'd like to go from duplexes to be buying larger buildings. What are like, other than what we've kind of discussed, what are maybe one or two key critical, let's do two or three key critical things that you think were really important for you to be able to be successful?
So before going in, like, what was like kind of the behaviors I had, or
either behaviors you had or steps you took, okay. What were some of the big steps that you had to take in order to actually be successful?
Got it. So I am a very much burn the ship person. Just my personality, I can't have a way to retreat. So for me to make that jump, again, the people, it's that limited mindset. So I got the education, 2018 and all that area. I went out, read all the books, all the big books out there for commercial investing, joined the coaching group. And I was like, all right, I gotta burn the ship. Like, there's no going back. It's multifamily or nothing. So that was a big thing for me, which is burn the ship and jump in, jump in, just do it, figure out on the way there. Having the discipline and the accountability is huge, especially if you're somebody that, if you know yourself and you know that you procrastinate a lot, or you'll try to make excuses up, for yourself, or like, oh, I couldn't do this because of this. Like, you're making an excuse. Like, you might be telling other people that, but you're not gonna be able to look in the mirror and keep saying that excuse over and over again. Like, right. The buck has to stop somewhere. So having the accountability and the discipline and no excuses, just get it done. And having that, personal responsibility, I think, is really huge. And let me think. Just always be getting education, kind of check your ego, I think, is a big one too. A lot of people have, they get, kind of ego gets in the way of their own, of themselves. So, kind of checking the ego, being humble, realize that, yes, I can probably learn something from this person half my age or something like that. Or, I don't know, there's a lot of different examples of that, but especially getting into other groups and other team situations, I think check the ego is very important as well to be successful in business. Because otherwise you just get in your own way, and it's very detrimental to your growth.
Yeah, for sure. For sure. What's a favorite book that you can recommend to our listeners?
What topic?
What's your favorite book?
Oh man, I have so many favorite books. So to keep in the vein of what we've just been talking about, The 7 Habits of Highly Effective People is one of the foundational books that I've read to really get my butt in gear, take responsibility for, my life and my actions, and, stop making excuses. Like, it's up to me. Like, I can't blame this on anybody else. I can't make, woe is me kind of excuses. If I want this, then I'm going to be the one that has to make the moves and make it happen. So the 7 Habits of Highly Effective People, Stephen Covey. I'm actually rereading it right now for like the third or fourth time.
What's one of your habits? What's one habit that you think is really critical for yourself that you have?
For myself, I would say the private wins of just the accountability, I think, is very important. I think it's something that a lot of people lack, is personal accountability. I've kind of said it a couple times, but I think that's the biggest one. And that's kind of how the whole book starts out, was like, just stop making excuses, take accountability for yourself. If you want something bad enough, what's your why? Why do you do this? The why has to be very strong. And once you figure out that why, there's no excuses.
Yeah.
Right. An example of that would be, why do we invest in real estate? Well, to make a lot of money. Like, no, that's not why. Like, why do you invest in real estate? Well, it's, financial independence. Why? Well, because I have these wife and kids and I want to spend time with them. Why? Well, because I grew up and my parents were never there. My dad was working all the time. My mom was, whatever. And I didn't have that. So I want to have it for my children. I'm like, okay, now we have a why, right? You want to provide a life for your children that you didn't have. And then it get pretty strong. People can get really emotional about it. And that's where you need to be. And then now it's like, okay, you have that why. Now it's, what are you willing to give up to make sure that is a reality? And once you compare that to like literally anything, like Netflix saying, Netflix, the game on Sunday, going to the bar with, friends, it's like my kids, self-esteem and confidence and future and growth as, smart, healthy, citizens, or like football.
Yeah.
Right. So it's like, it makes it very easy. And a lot of people just never even go down that exercise of just like,
because it's uncomfortable.
It is uncomfortable. But that's where you need to get to. You need to get to that uncomfortable, mushy, emotional feel, to find that why and put that at like the forefront of every action you do. And when you look at opportunity cost, and that's another question, kind of that back to the habit thing, is I always look at opportunity cost of like, which is, this decision versus that decision. Am I willing to pay that price? Right. So I'm like, okay, I can do this, invest in, this LP position over here for 30 grand in my own deal or somebody else's deal. Or I can go buy, a Tesla. All right. So a Tesla sounds pretty cool, but what am I giving up? Well, I'm giving up that feeling of being able to provide for my children and giving them the life. And then it's like, oh yeah, Tesla suck. Like I'm going that route. It's not even a competition anymore when you break it down like that.
Yeah. Yeah, absolutely. I couldn't agree more. Vincent, what last question here before we wrap up? What are your 3 pillars of wealth creation? 3 pillars of wealth.
Oh man, 3 pillars of wealth. I probably should have been prepared for that one, huh?
Nope.
Oh, okay. So I say team accountability. That's been one of the themes of this call. Accountability, teams, and I don't know, systems and processes are pretty good.
Perfect. Love it.
I don't know if that's perfect. I'll probably as soon as I get off the call, I'll be like, man, I should have said this one. But
no, I like what first comes to people's heads. That's what I like to. I don't love preparing people for questions because then you just think too hard. I want what's natural. Well, good stuff. I really appreciate you joining us. How can our listeners get in touch with you, learn more about what you got going on, and just get to know you?
Of course. Yeah. So we have tricityequity.com is our website. Or you can reach out to me on Facebook, LinkedIn. Vincent Gethings, pretty uncommon name. So pretty easy to find on Facebook and LinkedIn. Awesome.
We'll link that all to the show notes there too, so everybody can just go on the show notes and get in touch with Vincent if they want a conversation. So again, appreciate you joining us, and you have a fantastic rest of the day.
Thanks. You too, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So The other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.